Welcome back. U.S. President Donald Trump's tariffs appear to be weighing on North American markets once again and all the uncertainty they create. This week, for instance, he announced a 50% tariff on goods from Brazil, as well as a 50% tariff on copper coming into the United States. My next guest says visibility could be poor for the remainder of this market year. Let's bring in Tim Chubb, Chief Investment Officer at Girard. He's our first guest this hour. Tim, thanks a lot for joining us. What is your view on market visibility given the macro environment?
Yeah, it's been pretty challenged. It's ultimately headed into earnings season here. I think we're going to get a little bit more color, given just the length of time that we've seen some of this tariff policy be enacted. But speaking with some clients, towards the end of the month last month, and as we get into the new quarter here, and they're asking, why have we seen the markets at all-time highs? Well, we haven't had any trade headlines. Of course, that's changed. The letters going out this week. With the news about Brazil, which is concerning. Ultimately, a big piece of the rationale for this tariff policy has been associated with reducing the trade deficit and the president's objectives there. But the impulses, unfortunately, I think have now sort of gone beyond that with Brazil in particular, as the U.S. actually has a trade surplus with the country of Brazil. And so as we go into earnings season, I know it's a bit of a low bar coming in for S&P 500 companies, looking at about a 4% growth rate year over year. But it's really going to come down to the color that we hear from management teams and how they're wading through this foggy forest of tariff policy and what it might mean for both demand as well as trade challenges. I
spoke with a portfolio manager earlier this morning, and his view was on the macro and the policy environment is that the big taxation and spending bill in the United States, the so-called Big Beautiful Bill, not so-called, that's its official name, that bill is stimulative to markets because it involves tax cuts that will put more money in the hands of U.S. households, and he believes some of that money will find its way into the stock market. He also says the most recent jobs numbers in the United States continue to show a very healthy employment market in the United States. So he says both of those things are positive influences on markets. Do you agree?
To some extent with respect to the tariff, the tax cuts, it really in many ways was just an extension of what was passed in 2017. I think there's always going to be resilience to the market. Our country has moved away from pensions and our 401ks have become our pensions. And so, making those biweekly contributions really puts, an incremental buyer into, U.S. stocks. But A, valuations are all-time highs. B, investors are at all-time high exposure, U.S. investors, to U.S. companies, the stocks generally within their 401k and other investment assets. And so I just don't know what the catalyst is to move higher from here. Again, going back to, some of the comments about the labor market, I wouldn't characterize this as a healthy labor market in a lot of different ways. The jobs report, was really concentrated within state and local government. We saw jobless claims and continuing claims this morning, slow to hire, slow to fire. People are finding it to be much more challenging to, get jobs once they're laid off. And companies have been slow to fire, coming out of what we experienced throughout the pandemic, where, it was so challenging to find, capable labor during that, year or two there. So I really wouldn't characterize the labor market. It's starting to show some, cracks and softness under the surface. And, I think it's in many ways sort of the bifurcated nature of what we've seen within credit markets or even the stock market overall. Within stocks, breadth has narrowed. You really have seen just fewer and fewer companies continuing to charge the market higher. And within credit markets, it's sort of been this slow grinding erosion. And I think that's analogous to what we've seen within the labor market recently.
Okay, you mentioned earnings season, which is not far away for S&P 500 companies. In terms of commentary from senior executives, how much of a grasp do you expect to get on business confidence by the time earnings season is over?
Yeah, I'd say anything is better than where we're at right now. Ultimately, it really comes down to how are they mitigating tariff policy. Nobody knows where this will end at the end of the day. And so these companies are responding to it in real time, trying to get a sense of how much they anticipate passing on in price increases, given the consumer is already extremely sensitive to higher prices and inflation after the last several years coming out of the pandemic. How much is going to be eaten in margin? Do we need to revise our estimates for 2026 lower on margin compression that's going to be coming from higher costs that just can't be pushed through ultimately? And so, that's really where the rubber is going to hit the road this quarter, is just what is that composition of that tariff? How much is being ultimately passed on to the consumer? How much of it is being eaten in margin? And do we need to make some adjustments to 2026 numbers based upon that, which obviously with multiples at these levels, I think could present some volatility for the market.